When you're facing a very volatile market, as we're doing now, the most important thing that any investor can do is keep their risks under control. And the problem with that is there's really no way to define what that means to any individual. Certain people are much more risk tolerant than others. So let's start with the least risk tolerant among you and work our way out. If you're not particularly comfortable with the risks you're taking, and that would be the sort of thing when you look at your statement and see that you are down along with the market, and you really can't abide that loss and it bothers you, that means you're taking too much risk. Basically, investors have to be able to recognize that while there are good times, and most people tend to enjoy those, there are inevitably bad times, and what we've seen recently is particularly extreme in terms of the move going from a raging bull market to essentially flirting with a bear market in the space of a couple of weeks is fairly unprecedented. Even the 1987 crash, where we fell 20% plus, the markets had sort of been starting to fall beforehand. That sort of conveniently gets left out when they mention, oh, markets have never fallen this fast. Yes, they did, 29 and 87. But in terms of a normal non-crashing market, this is really extreme. So the question would be, how much does it bother you? And also, how much are you, if you're losing, how much are you losing relative to the market? So effectively, what is the beta of your portfolio? If you're extraordinarily risk averse, the beta, which is generally speaking the amount that your portfolio moves plus or minus in percentage terms, plus or minus the broader market. And I always use the S&P when I refer to broad market. But for example, if you have a beta of 1 in your portfolio, well then if the market falls 3%, you would expect to see a 3% loss in your portfolio, plus more or less. And you got to recognize that that's pretty much the case in point for your portfolio. And hopefully you wrote it up during the good times and you're giving some of that back now, unfortunately. The problem becomes if you start to have what I would call excessive beta. Maybe you were doing really well in the up market, which was outperforming. And so let's say if when the market was up 10%, you were up 15 or 20. Well, you'd have to expect that when the market fell 10% or more, you would lose 15 to 20%. That would mean that would imply that your beta is in the 1.5 to 2 range. And you've got to decide that if you can't cope with the loss, if you like the wins but can't cope with the losses, you've got to do something different. What it should mean is that in hindsight, you probably should have been hedging, because people are not usually gain averse, they're usually risk averse. And so you would want to have done something to minimize your downside while keeping your upside. But that's hindsight. So what do you do now? You have to decide if you're willing to keep that higher beta exposure and ride the ups and downs for all they're worth, or if you want to move to a lower beta profile. I mean, obviously the lowest beta profile is essentially going to cash, which is effectively 0 beta. But then remember, you're not going to participate on the upside if you do that. So you have to be intelligent about, and no one can do this for you. You have to really self-assess what level of risk you're willing to take, and not just on the upside, on the downside, because I think what we're going to get is some chop here and there. And so you're going to get days where you're going to go up, and are you going to be upset if you missed a rally, or are you going to be more upset if you participated too much on the downside? You have to assess all that, and generally what it means is when times get risky like this, you may want to pull back on your risk because it's very difficult to control. And probably one of the better ways to do that is to move to a lower beta profile, whether that's more defensive stocks, whether that's adding cash to your portfolio. But there are ways to sort of add and subtract risk. And unless you are extraordinarily risk tolerant or extraordinarily lucky or extraordinarily good, you probably want to be thinking about how to de-risk right now and ride out these volatile times until things get a bit more clear.